Fed cut rates by 25 basis points, but what does that even mean for your money? Well, Yahoo Finance's own Molly Moorhead is here to break it all down. So Molly, how will this latest decision impact consumers?
Hey, Brad. When the Fed makes a move like this, we don't see an immediate direct impact in our various types of accounts. It's more of a trickle down. So, starting with savings accounts, the interest rates that banks pay on our savings will come down as the Fed cuts rates. And so, while rates were really high, savings accounts were paying upward of 5%. It was great. But as they've been lowering rates, those APYs are coming down and they will continue to come down. So your best bet is to just shop around for the best account offering the best interest rate. And you're probably going to find that at a online bank with a high yield savings account.
Interesting.
Next, credit cards would be next. On the other end, the interest we pay on our debt, those rates have been crazy high. 25% in some cases. And unfortunately, we're not gonna see a big change there just because the Fed cut rates by a quarter point. So you're better off calling your credit card company and just asking them to lower your rate. Don't wait around for the Fed, especially if you're carrying a credit card balance. Ask for a lower rate. Anything you can do to help minimize the interest you're paying and get that balance paid off.
Lastly, Molly, we got to talk about mortgages. How is that anticipated to be impacted?
This is the weird one, right? The housing market's just in such a strange spot. And as the Fed lowers interest rates, we would expect to see mortgage rates come down, but it's just not a one-to-one relationship. And if you remember back in September when they first cut interest rates this cycle, mortgage rates went up. So there's just a lot of different factors that affect mortgage rates. And so it's things like home inventory is really low. That's keeping prices high. We have millions of people who have locked into a mortgage rate below 3% that they got, during the pandemic or before. And so they don't want to sell and they don't want to move. All of that is keeping the housing market kind of in this log jam. And unfortunately, with the Fed saying that there's likely to be probably more like 2 rate cuts next year instead of 4, that's going to also keep mortgage rates high. But again, the overall trend of lowering interest rates should help the mortgage market keep us below 7%, maybe into the low 6s next year.
Molly, thanks so much for breaking this down. Really appreciate it.
Thanks, Brad.